The Internal Revenue Code allows, under what's called Section 1035, for the exchange of certain types of insurance products without creating a currently taxable event. So Section 1035 of the Internal Revenue Code. The basic rule here is that you can never do something that betters your tax position. You can never avoid taxes. So this idea under Section 1035, I can switch from one life insurance policy to another, from life to life. So what we're talking about here is taking out our cash value out of one cash value life insurance policy, not paying taxes currently, and putting it into another life insurance policy. Life insurance proceeds are tax-free, so we didn't change our tax event at all. We are still in life insurance. So you can go from life to life, where a lot of times, if you had just, let's say for example, let's say you'd paid in $20,000 in premiums in life insurance and you took cash surrender and got out 30, normally the $10,000, the difference there would be taxable as ordinary income. But if we do it under a 1035 exchange and we take the $30,000 and we buy a different life insurance policy with it, then we don't owe taxes currently. So life to life is perfectly fine. What else is allowed? So life to life, okay, life to life. You can take cash surrender out of an annuity and use it to fund another annuity and not owe taxes currently under Section 1035. That's a tax deferred event. You're not bettering your tax position. You can go from life insurance to an annuity. So if you were to do that, whatever you'd paid in premiums in your life insurance is your cost basis in your annuity. So you're not avoiding taxes, because we just talked about the taxability of the earnings in an annuity, how it works if you took cash surrender during pay-in, how it works when you annuitize. So you didn't avoid taxes, so that's okay. So these three things are all allowable. This last one is not allowed. Okay, so Section 1035 says you cannot take cash surrender out of an annuity and use it to fund life insurance because life insurance proceeds are tax-free. So an annuity to life insurance, no, you can't do it. Life insurance proceeds are tax-free. So if I was going to take cash surrender out of my annuity, I would owe taxes on the earnings. Ordinary income, if I was under 59.5, I'd also owe a penalty. Then I can take the money and go and buy an annuity, fine. Or go and buy life insurance, fine. But it is not allowed under Section 1035 as a tax-deferred event. You cannot go from an annuity into life insurance because then you would have beaten the tax system, which they'll never let you do. It is true under Section 1035 that the exchange may be done with the same or a different insurance company. If it is a life insurance policy that's involved, the policies must be on the life of the same insured. If the exchange involves an annuity, the contracts must be payable to the same person. Tax treatment of variable life insurance. Now, I kind of talked a little bit about this in this whole Section 1035 exchange rule, but let's do a little review or a little preview. Variable life insurance. So variable life insurance is protection. As such, you must pass a physical. Your premiums are based upon your age, your health, your gender, your hobbies, all of those wonderful things when you buy the policy, so it is subject to underwriting. Let's say you get a face amount of $100,000 and you're paying in a premium of $1,000 a year. So the premium for variable life is fixed. $1,000 a year. This is after tax dollars that goes to buy your life insurance. Let's say you've been paying in premiums for 10 years and your cash value, which because it's a variable product is in the insurance company's separate account. Let's say you've been paying in premiums for 10 years, your cash value is $9,000. So far you've paid in $10,000, 1,000 times 10 years, your cash value is $9,000. You take cash surrender. If you take cash surrender out of your variable product, if you take cash surrender and you get out less than you put in, so at this point you paid in $10,000 in premiums, you do not owe taxes. The only time you would owe taxes is if you took cash surrender. Let's say your cash value now is $19,000. You put in $10,000 worth of premiums. The difference, the $9,000, taxable as ordinary income. When you take all of your cash value out, you have no more protection. There is no early withdrawal penalty. Life insurance is protection, where an annuity is a retirement account plan sort of like thing. It's not a qualified plan at all, but it's a retirement product. Annuities are generally sold to people looking to save for retirement. So there's no early withdrawal penalty on life insurance. Now, if I bought this policy today, I paid in one premium and I die, how much goes to my beneficiary? The face amount of the policy, tax-free to the beneficiary. Your life insurance policy face amount, death benefit, is always tax-free to the beneficiary. If it's a policy that I own on my own life, it is included in the value of my taxable estate, included in the value of the insureds, if they own the policy on their own life, taxable estate. So that is important. Life insurance face amounts, when you own the life insurance on yourself, they are included in your taxable estate. Doesn't matter who the beneficiary is, whether the beneficiary is your spouse, your friend, your kid, it doesn't matter. If you own the life insurance policy on your own life, the face amount is included in your taxable estate. Instead of taking cash surrender out of your variable life insurance policy, you can always take out a loan. So if let's say I have this cash value of $19,000 and I take out a $5,000 loan, the insurance company gives me a $5,000 loan, makes a note against my cash value. What's paid when I die? Face amount minus loan plus interest on the loan. So you can always access your cash value in the form of a loan. Anytime you take out all of your cash value, there's no more protection. So if you don't want to do that, but you want to access some of the earnings in there, just take out a loan. Loans are not taxable. There is interest, of course, charged on the loan. Retirement plans. So a basic overview of how retirement plans work, what's available for your clients. In this section, I will not discuss limits. The following section of the course will discuss the current year's contribution limits. IRAs, individual retirement arrangements. IRAs. There's really two types of IRAs that your client may have. IRAs. The key to having an IRA is that you must have earned income. So you have a job, you have earned income. There is the traditional IRA, and then there is the Roth IRA. Is it possible to have a 401k where you work and fund an IRA? Yes. Always. So long as you have earned income, you can always have whatever you have at work plus an IRA. There's some differences between the Roth and the traditional that you must be aware of. The Roth IRA is always funded with after-tax dollars. Always funded with after-tax dollars. The Roth IRA earnings are federally income tax free. If it's what we call a qualified distribution. And I'll explain that momentarily. The Roth IRA does not have the 70.5 rule. You can continue to put money in no matter how old you are as long as you have earned income, but not too much. So the Roth IRA does have an income limitation. If you earn too much, which is discussed in the current year's contribution limit video, you cannot fund it. But you don't have to start taking money out at 70.5 like you will have to do in a traditional IRA. You can continue to fund it if you're over 70.5. The money goes into the Roth in after-tax dollars. It's like a glorified savings account. That money is your money to take out at any time. No tax, no penalty. It's your after-tax dollars that goes in. So it's kind of like a FIFO distribution, first in, first out. So for example, let's say you put $3,000 into your Roth IRA this year. Next year, the account balance is $4,000. You can take out $3,000, no tax, no penalty. In order for the earnings, that $1,000, to be able to be taken out without federal income tax, the rule to have a qualified distribution is the account must have been opened at minimum 5 years, and the earnings must be paid out on or after age 59.5. So in order for the earnings to be federally income tax free, those two things must be true. The account must have been open for a minimum of 5 years, and it must be paid out on or after age 59.5. Roths are really popular. The problem is with the income limitation on it, not everybody who wants one can directly fund a Roth today. If you earn too much, which is discussed in the current year's contribution limits, you cannot directly fund a Roth. So what can you get? There's a traditional IRA anyone with earned income can have. Generally speaking, because there are maximums that vary by year as far as how much you can put into these products, people either do the traditional or they do the Roth. I suppose you could put a little in each, but nobody does that. They either do one or the other, or they don't do it at all. But you couldn't put the maximum into both. The IRA limitation by year is total into all of your IRAs. So the traditional IRA is for anyone with earned income. I don't care how much earned income you have. You do, however, have to stop putting money in and start taking money out no later than April 1st of the year after you turn 70.5. So it does have a 70.5 rule. So the 70.5 rule applies. If you don't begin what's called your required minimum distribution out of your traditional IRA, you will have a 50% IRS penalty. That's huge, 50% of what you should have taken out of the RMD. So anyone with earned income can have it as long as they're under age 70.5. The money may be tax deductible, but it's not always. So there's this concept, when you fund a traditional IRA, you're always doing it with after-tax dollars. But sometimes you're allowed a write-off on your personal return for the amount of your contribution. And sometimes you're not. If you're not allowed to write it off, then the money you put in is in after-tax dollars. If you are allowed a write-off of your contribution on your personal return, then the money you put in is in pre-tax dollars. So to get pre-tax dollars means you are able to take a tax deduction on your personal return. How do we know if you can? There's a two-step rule. So it says that if one and, it's a two-step rule too, if you earn too much and you have a qualified plan where you work. So now, exactly where the too much is once again something I will discuss in the contribution limits video. It's not like that on the test though. It's going to be a preschool teacher who earned $25,000 last year, has a qualified plan where she works. Can she fund a traditional IRA? Yes. Pre-tax or after-tax dollars. Did she earn too much? No. So pre-tax dollars, which means she got to take a write-off on her personal return. Your client, he's single, he made $300,000 last year. He does not have a qualified plan where he works. He made too much to fund a Roth. Can he fund a traditional IRA? Yes. Pre-tax or after-tax dollars? Not pre-tax dollars. Why? Yes, he made too much, but he didn't have a qualified plan where he works. So that's a key. It's a two-step rule. Now, the IRA itself, what can it own? What can it own? Mutual funds, stocks, bonds, exchange-traded funds. It can own securities. It can own retirement annuities, whether or not they're fixed annuities or variable annuities, both are allowed. It could own certificates of deposit, bank CDs. It can even own gold and silver coins. It can own gold bullion. You could even have a self-directed brokerage account where you purchase whatever securities you want to buy. Those are all allowable funding vehicles for the IRA. The test likes these. You cannot use the money in your IRA to buy life insurance. That is prohibited. You can also not use the money to buy collectibles, such as stamps, artwork, antiques, and precious gems. No. Can you buy certain types of gold and silver coins in your IRA? Yes. There are very specific types, though, so you'd really want to read the Internal Revenue Code to make sure you're buying the right kinds. We talked about the 70.5 rule. Which one, traditional or Roth, has the must begin distributions no later than 70.5? Traditional. When your client has a traditional IRA, if they have a non-working spouse, they can open up for their non-working spouse their own spousal IRA. That non-working spouse is allowed to contribute up to the current year's contribution limits into that IRA. Not one account, but two, one for the working spouse and one for the not working spouse. Rollover IRAs, individuals are allowed to transfer assets from an IRA or a terminated qualified employer plan to another IRA once a year. The new IRA is called a rollover IRA, and its purpose is to provide flexibility of transfer and investment for retirement savings. Rollover IRAs can be more than one IRA, and any amount of a qualifying distribution to the taxpayer can be transferred to a rollover IRA without being taxed if the transfer is completed within 60 days of the distribution. So if you leave where you work and you want to roll your account balance, let's say it's your 401k, out, you can. You put it into a rollover IRA. You need to do that within 60 days, however, to not have a taxable event. The best way to do it is directly from one trustee to another. That avoids any income tax withholding because it's not going into your hands at all. Individuals establishing rollover IRAs can be active participants in an employer's retirement plan. A non-qualified plan is not eligible for rollovers. You have every year up until April 15th, which is the tax due date, to fund the previous year's IRA contributions. Excess contributions. Every once in a while, I have a student who comes along and says, I had no idea there was a limit as to how much you could put in an IRA. There are people out there that didn't realize that. If you put in too much, it's subject to an excise tax. It's a 6% penalty tax. Get it out. You shouldn't put more than whatever the current year's contribution limits are. Ways in which you can get money out of your traditional IRA. Allowable distributions, those without penalty, may begin as early as 59.5, must begin by 70.5. During this period, the individual may elect to take distributions from the account at any time and for any amount. The participant may also elect to make either deductible or non-deductible contributions to his or her IRA during this time period. You can continue to fund the IRA as long as you have earned income up till 70.5. There are 3 methods of allowable distributions from your traditional IRA: the withdrawal of the entire balance in a single sum, the election of installment options based on the individual's life expectancy, or the joint life expectancy of the participant and his or her spouse, the purchase of an immediate IRA, single or joint life annuity from a life insurance company. How much of the money you take out is taxable depends upon what your cost basis is. So remember, in a traditional IRA, you can have a mixed cost basis. Some of the money may have been tax deductible, which means it has a zero cost basis, and some of the money may have been in after-tax dollars. So you have to keep track of a mixed cost basis. If every contribution had been tax deductible, then your cost basis is zero. Withdrawals are 100% taxable as ordinary income. Money taken out under 59.5 is subject to a 10% penalty. Because your cost basis is zero, all the money you're taking out would be subject to penalty. IRA distributions are never subject to long-term capital gains rates. It's always subject to ordinary income. It has, similar to when we had the variable annuity and we had tax-deferred earnings, right? The IRA has tax-deferred earnings. So in exchange for the tax deferral, when you do take it out, it's ordinary income rates. When the individual has a mixed cost basis, you have to figure out what percentage has been taxed, which percentage has not been taxed, and then your withdrawals are partially taxable and partially not. A premature distribution from an IRA is any distribution of funds that occurs before what age? 59.5. It's subject to a 10% penalty, the earnings that you take out under 59.5, with slight exceptions. So distributions made due to the following circumstances are not subject to the penalty: the participant's death, disability or divorce, qualified higher education expenses, first-time homebuyer expenses up to $10,000 over their lifetime, rollover distributions, annuitization, based upon life expectancy of 5 years or age 59.5, whichever is longer. So you can annuitize your IRA early without penalty. That's also true for a variable annuity. You can annuitize at any age without penalty. They will waive the 10% early withdrawal penalty if you're taking the money out, the earnings out, for medical premiums for unemployed individuals, as well as medical expenses that are in excess of defined adjusted gross income limits. So that's really tied to the amount. When you itemize on your personal return, if your medical expenses are in excess of a certain percentage, that varies by year. So that is kind of subject to fiscal policy tax law change. So those are reasons why we will waive the 10% penalty on the early withdrawal. IRA distribution options, as far as when the IRA owner dies, the distribution options depends upon whether the IRA owner died before or after account distributions began. We know traditional IRAs require that the minimum distribution begin no later than April 1st of the year after the account owner turns 70.5. If the account owner does not designate a beneficiary or name his estate as beneficiary and dies before distributions begin, the account balance will be distributed according to the 5-year rule, which requires that the entire amount in the IRA be distributed no later than December 31st of the 5th year after the owner's death, either as monthly payments or as a lump sum. So that is the rule. If the IRA owner did not name a beneficiary, did not name his estate as beneficiary, and dies during, before starting to take money out. If, however, the IRA owner died after distributions began, the account balance must be distributed according to the terms selected by the owner. If the IRA owner designated a beneficiary other than their spouse and dies before distributions begin, the IRA must be distributed in accordance with the 5-year rule, as we just discussed. However, non-spouse beneficiaries also have the option to receive distributions over their own life expectancy as long as they elect to take the initial distribution by the end of the year following the death of the IRA owner. Non-spouse beneficiaries may not roll over an inherited IRA into their own existing IRA. If the IRA owner had already begun to receive distributions at the time of death, the remaining distributions must be paid out at least as rapidly as they would have been under the method of distribution in effect prior to death. If the beneficiary selected is the surviving spouse can avoid the distribution rules that we just discussed by electing to treat the inherited IRA as their own IRA. If this election is made, the surviving spouse is treated as the IRA owner for all purposes and will not be subject to the required minimum distribution rules until they reach age 70 and a half. Further, the surviving spouse may also designate a new beneficiary and elect to receive distributions based upon their joint life expectancy. We talked about the Roth IRA, available to anyone, regardless of age, who has earned income. Granted, if you earn too much, then you can't directly fund it. But something that's interesting. So let's say your client earned $300,000 last year. They can't directly fund a Roth. But what they can do, and they're an active participant in an employer-sponsored plan, they can fund a traditional IRA one day, and you're allowed, no matter the client's adjusted gross income, you can roll your account balance from a traditional IRA into a Roth. It's literally the back door into the Roth, which makes me wish they just remove the income limitation on the Roth. So if you have a client who's in this situation, Roths are very, the idea of having earnings be federally income tax free is very attractive, especially when we don't know what income tax rates are going to be like when we reach retirement age. So anyone who wanted to fund the Roth but can't directly fund the Roth can always fund a traditional IRA and after-tax dollars and then do a rollover. Any amount that has not already been taxed, because anyone can do a rollover from a traditional into a Roth IRA. Any amount of money of the traditional IRA balance that has not yet been taxed as taxable as ordinary income in the year of the rollover. So it's a very popular backdoor way to get into a Roth. We talked about the qualified distribution rules in order to have the earnings be federally income tax free. You can always take out your Roth contributions at any time. It's your money, no tax, no penalty. Employer-sponsored retirement plans. So these are things like a 401k, a SEP IRA, a SIMPLE, a KEO, a TSA, which is a tax-sheltered annuity. The reason why employers do nice things for employees is generally because they want to retain their good employees and they want a tax write-off, right? So employer-sponsored retirement plans. Whatever amount of money the employer contributes for the employee is tax deductible to the business as a business expense. Any money that you, the employee, choose to put in is also in pre-tax dollars. Qualified plans have a zero cost basis. Qualified plans have a zero cost basis. No, nothing's been taxed yet. 100% taxable is ordinary income upon withdrawal. It's a retirement plan, early withdrawal penalties. If you take out money under what age? Yep, 59 and a half. What's the penalty? How much? Yeah, 10%. 10% penalty. So if you take $10,000 out of your 401k and you're in a 30% tax bracket and you're 55, you only get $6,000 after you pay taxes. So it's pretty significant encouragement not to do this.